This week, we will consider the notion of strategic financial contracting. So what is strategic behavior? So you're behaving strategically when you take into account the consequences of an action, not only on yourself, but also on the behavior of other economic agents. So for example, in the Kyle model of stock market trading, we saw that the insider, the informed investor, was strategic because he was taking into account the price impact of his trades. Okay, he was taking into account how his market order would affect belief updating by the market maker, which would in turn affect the price at which the informed investor would be able to trade. Okay, so here we're going to take a similar perspective, and we're going to study how agents behave strategically in a corporate finance context. And so we're going to take the perspective of a corporation. And we're going to study this, this article. So predation has a pretty simple premise. So this is the idea that on a particular market, there's several corporations, and some are deep-pocketed, some have a lot of money, and others are not so wealthy. And so the former may want to drive the latter to bankruptcy, for example, by engaging in a price war, or by aggressively pushing their products through advertising. And so they would essentially drive them to bankruptcy, right? So the notion of financial predation. However, this story seems to be incomplete, right? Because if you take into account the perspective of a firm at the time when it's going to consider whether or not to still be in business, any losses it incurred in the past should be irrelevant, right? As long as it has access to positive NPV projects, it should still survive. It should still be able to fund these projects, invest in these projects, and so remain in business. And so here the idea was that predation would be a sunk cost. At the time when you decide, when you consider new investment opportunities, you're not going to really care about what happened in the past, whether you were the target of predation or not. But of course, this assumes this perspective that predation would be a sunk cost and therefore would be useless, would be ineffective. This perspective assumes that a firm can always invest in a positive NPV investment. And we know that when there are frictions, this is not always the case. Let's try to study a model to understand these issues a bit better. So there's two firms. A firm which is deep-pocketed. So that's a firm with a lot of money that might be tempted to engage in predation. Okay, it does not need external funding. So for this firm, it's really going to invest in any project with a positive NPV. Okay, so here there's no distortion in terms of investment decisions. And in the same industry, there's also a constrained firm. So that's firm 2, that does not have deep pockets. And so this firm is going to be reliant on external funding. So it can, more specifically, it can only fund investment in the first period. And it's going to be a model with 2 periods. Okay, and so in this case, it's not automatic that this firm will be able to fund any investment with a positive NPV in the second period. Okay, and so this in turn is going to introduce a role for predation by the deep-pocketed firms, so firm 1, in the first period. Okay, so what can firm 1 do? So in the first period, it can engage in predation. And again, predation, think about a price war or any other tool that is at the disposal of firm 1. So that's any action which is going to be costly to firm 1, but it is also going to be costly to firm 2. And so here the idea is that because firm 1 is deep-pocketed, it can sustain some losses, but because firm 2 does not have so much money, it may not be able to sustain all these losses. And so here we're just going to assume that predation is going to reduce the profits of both firms for this period. And in particular, firm 2 profits, which would otherwise be equal to capital A, following predation, are only going to be equal to little a here. Okay, In the second period, so the model is quite similar to the standard Tyrrell model. The difference is that the profits are going to depend on the industry structure, whether it is a monopoly or whether it is a duopoly. And so more specifically, firm profits are going to be higher if there's only one firm operating in the industry, and so the firm is a monopoly. And they're going to be lower if there's two firms operating in the industry, so the industry would be characterized as a duopoly. So regardless, the investment cost at the beginning of the second period is I, so it's very standard. There's going to be a moral hazard problem, so that's going to introduce a friction that is going to result in positive NPV investments not necessarily being funded. And so the probability of success with effort is PH, and it's only PL without effort. Okay, and of course, if you don't exert effort as a standard, you get, as a manager, you get some private benefits B. Okay, so the manager is going to need some incentives to exert effort. So what are the profits? In the standard Tyrrell model, the profits were equal to R. Here, the profits are going to depend on the number of firms operating in the industry. Okay, if there is only one firm that succeeds in the second period, so profits are equal to M because this firm is a monopoly, so it's making monopoly profits. And if both firms succeed in the second period, they're going to make duopoly profits D each. So this means that in equilibrium, effort is going to be induced, right? So the probability of success is going to be PH for any firm. And so in equilibrium with probability PH, each firm is going to get the following expected profit. That's going to depend on whether the other firm succeeded or not. Okay, so this is your own probability of success. And here this refers to the probability of success of the other firm. So if the other firm succeeded too, well, there's two firms on the market, so each firm is going to make profits, duopoly profits D. If the other firm failed, so that's with probability 1 minus PH, it failed, so you are the only firm that succeeded, right, with probability PH, and so you make monopoly profits M. And so here we're going to assume that all this is greater than I, meaning that the investment has a positive NPV. Okay, so let's try to understand better how this works. So there's two firms, firm 1 and firm 2. If both firms succeed in the second period, so each get duopoly profits of D. If firm 1 succeeds and firm 2 fails, then firm 1 gets monopoly profits of M, and firm 2 gets 0 profits, right? It's a failure. Likewise, if firm 1 fails, but firm 2 succeeds, firm 1 gets 0, firm 2 get monopoly profits M, and if both firms fail, each gets 0. So that's for the second period. If you look at it this way, in terms of the probability of success and failure and what you're going to get in each case, from the perspective of a firm that's going to exert I effort, so it's probability 1 minus PH, it's going to fail, so it's going to get 0 in any case, right? If you fail, you get 0 in any case. And with probability PH is going to succeed. Then it's probability 1 minus PH, it's the only firm succeeding, so it gets monopoly profits M. And with probability PH, it's the other firm is also succeeding, and so each firm gets duopoly profits D. So there's several possible cases in this model, right? We're going to focus on the interesting case, which is characterized by this equation. And so what is this saying? Let's start with the first inequality. So here this is saying that on the left-hand side, you have the investment by outside investors. And on the right-hand side here, you have the probability of success multiplied by, within parentheses, this is a pledgeable income. This is what you can pledge to investors. Normally in the Tyrrell models, this was equal to capital R. In this model, instead, this is pi. So pi, which is defined here, because this is what you get with probability pH if you succeed. Okay, and so here we assume, so this is in expectation, the maximum amount that can go towards the outside investor. And this is larger than the funding required from the outside investor on the left-hand side. Okay, so it means that the investment can be funded, but only in one case, right? Because as you can see, this is capital A here. These are the profits of firm 2, as long as firm 1 did not engage in predation. So as long as firm 1 does not engage in predation, firm 2 can fund its second period investment. But if firm 1 does engage in predation, then firm 2 profits are only going to be equal to little a. And this is what would be available to fund second period investment. Okay. And so in this case, so if in the first period firm 1 engages in predation, then firm 2 makes profits of little a. And so it's going to need to raise this amount to fund the second period investment. And as you can see now, there's no way for an outside investor to break even in the second period, because the amount required from this outside investor is greater than what this investor can get in expectation, which is equal to this. In parentheses, again, this is a pledgeable income, what you can pledge to an investor. But the investor is only going to get this in case of success, which occurs with probability pH. So in other words, you can fund the investment as long as there was no predation in the first period and profits were sufficiently high for the firm subject to predation. But if there was predation in the first period, then your profits are low and you are not able to fund your second period investment. So this is the interesting case, right? This is the case when predation is going to make a difference. Otherwise, predation would not affect investment of the firm 2 in period 2, and so it would never happen. Okay, so let's consider the perspective of firm 1. So the firm that may or may not engage in predation. So it's going to compare the cost of predation. So predation is costly for both firms, remember. Here the cost is simply going to be denoted by K. It's going to compare the cost of predation to the benefits of predation. The benefits of predation is to get monopoly profits for sure, as opposed to getting monopoly profits only when firm 2 fails in the second period. Okay, so more specifically, if firm 1 engages in predation in period 1, in period 2, it's going to get monopoly profits with probability pH. If firm 1 succeeds in period 2, it gets monopoly profits M for sure, because firm 2 is not around. So firm 1 is always the monopoly. Now, if firm 2 is around, what is firm 1 getting in the second period? It's going to get this in expectation, right? So with probability pH, firm 1 is going to succeed. And then it gets, what does it get? Well, it gets pi, which is what it gets here. So it depends on the success of firm 2. If firm 2 succeeds with probability pH, firm 1 gets duopoly profits D. And if firm 2 fails, probability 1 minus pH, firm 1 gets monopoly profits N. Okay, and so this is net benefit from predation. The expected net gain from predation, which is to always be a monopoly as opposed to only sometimes being a monopoly. And if you rewrite this expression, this is equal to this, which is obviously greater than 0 because monopoly profits are greater than duopoly profits. And so already here you can see that the greater the difference between monopoly profits and duopoly profits, the stronger is going to be the incentive to engage in predation. Because when is firm 1 going to engage in predation? It's going to engage in predation if and only if this term is greater than K. So this was a pretty simple perspective in which firm could only enter short-term financial contracts. Now we're going to consider what's going to happen if instead firms can enter into long-term contracts with a lender. So think about a bank. And so the idea here is that if a bank is going to be committed to fund firm 2, so this is a firm potentially subject to predation, if it's going to be committed to fund firm 2 in the second period no matter what, for example. So in this case, there is no gain to predation from the perspective of firm 1. Because even if it reduces the profits of both firms in the first period, it knows that there's going to be a bank that is going to lend enough money to firm 2 in such a way that firm 2 will be able to fund the second period investment, and so will always be around in the second period. Okay, so then there's no benefits to predation, and then firm 1 is not even going to engage in predation in the first place. And consequently, actually, so that's actually interesting, the funding guarantee that the bank is going to provide in this case would not even be costly, because in equilibrium, predation is not going to occur. Commitments from banks can really play an important role. Now, the problem is that we still need to take into account moral hazard, in particular in the first period here. And the idea is that if the bank tells firm 2, so the firm potentially subject to predation, that is going to lend, is going to finance its second period investment in any case, then that may create moral hazard in the first period, in the sense that the manager may not be diligent, may not exert effort in the first period. Okay, so that's going to be a consideration to bear in mind. And that could be a potential cost of long-term contracts. So all these considerations need to be taken into account for strategic financial contracting. So the long-term contract is going to have an effect on the decision of firm 1 to engage in predation in the first period, but long-term contracts might also affect moral hazard in firm 2 in the first period. Okay, so we're going to need to balance these two considerations. And so this is how long-term contracts can be beneficial. So the first decision is by firm 1 whether it is or not going to engage in predation. If it does not engage in predation, firm 2 will always be able to invest in the second period. Okay, so that's the ideal outcome. If firm 1 engages in predation, then the question is, will firm 2 be able to raise funding for its second period investment, or will it be driven to bankruptcy? If firm 2 is able to get funding for its investment, even if firm 1 engages in predation, then you can see that there's really no benefits for firm 1 to engage in predation. It's just going to be costly, but it's not going to be beneficial from firm 1's perspective, because it's not going to drive firm 2 to bankruptcy. Predation is only going to be beneficial if it prevents firm 2 from getting funding for its second period investment. And so you can see that here, if firm 2 can always secure funding, firm 1 does not have any interest in engaging in predation, and so it's not going to predate in the first place. Okay, so let's build a model that incorporates all these considerations. Okay, so we're going to make a few additional assumptions. So now there's going to be moral hazard in both periods. And to make things sufficiently simple, we're going to assume that the probability of success following high effort is equal to 1. There's private benefits of exerting low effort in the first and second period. We're going to keep things simple. They are the same. They're equal to B0. Predation in the first period by firm 1 is going to result in 0 profits for both firms in that period. And so this is the cost of predation. You don't make any profits. But if you do not make any profits, of course, firm 2 will not have any money to fund its second period investment. So it's going to be reliant on external funding. We're going to make sure that under duopoly, so if there's no predation, investments have a positive NPV. So duopoly profits, which you get for sure if you exert effort, are greater than the investment cost. And so firm 2 as well A at the beginning of the first period, so it's going to be able to fund its first period investment, but it will not be able to fund the second period investment externally. This is the profit that firm 2 would get if it's operating in the second period. This is the cost of the investment. the firm can only pledge duopoly profits minus what it must give to the manager to prevent moral hazard in the second period. Okay. And so this is saying that if the firm does not invest some of its own money, it will be impossible to raise funding for the investment in the second period, even though the investment has a positive NPV. And so all these considerations are only relevant for firm 2. Firm 1 is self-financed, so it's going to be able to finance investments as long as NPV is positive. So what about firm 2? So firm 2 is going to enter into a contract with investors that specifies the probabilities of refinancing following success and failure in the first period. And so the idea here is that the lender is going to refinance firm 2 with some probability that depends on whether or not firm 2 succeeded or failed in the first period. So if firm 2 succeeded in the first period, the probability of refinancing is ZS. So if following a success, the firm is always refinanced, ZS is equal to 1. But the firm might also be refinanced following failure. Actually, this is going to be important to deter predation, because precisely the idea here is that if firm 1 engages in predation, and so firm 2 fails in the first period, it still needs funding for its investment in the second period. And this is what's going to be crucial in deterring predation. Okay, so you're going to have the probability of refinancing following failure in the first period. And so this equation here is a no predation constraint. It specifies under which conditions on parameter values and on the contract, the refinancing contract between firm 2 and its lender, firm 1 is not going to engage in predation. And so this is the case if what firm 1 gets if it does not engage in predation, the left-hand side, is greater than what it gets if it does engage in predation, the right-hand side. Okay. If firm 1 does not engage in predation, in the first period, firm 1 is going to get duopoly profits of D, because there's going to be 2 firms in the first period and with a probability of success equal to 1. In the second period, firm 2 is going to be refinanced with probability ZS, and so it's still going to be around with probability ZS, in which case firm 1 is going to make duopoly profits of D in the second period. But if it succeeds in the first period, firm 2 will not be refinanced with probability 1 minus ZS, in which case firm 1 will be alone and will make monopoly profits of M. Now, if firm 1 engages in predation in the first period, so then it makes 0 profits in the first period. In the second period, firm 2, which failed in the first period, will be refinanced with probability ZF, in which case firm 1 makes duopoly profits of D. And if firm 2 failed in the first period, it's not going to be refinanced with probability 1 minus ZF, in which case firm 1 is the only firm around in the second period and makes monopoly profits of M. The left-hand side are the expected profits over both periods of firm 1 if it does not engage in predation. And the right-hand side are the expected profits over both periods of firm 1 if it engages in predation in the first period. So how to rewrite this? We can just rewrite this equation like that, which gives us a condition on the refinancing contract parameters ZS and ZF, under which firm 1 is not going to engage in predation. And already we can identify some of the determinants of a predation. If duopoly profits are very low, firm 1 has a strong incentive to engage in predation. That makes sense to enjoy monopoly profits instead of duopoly profits. However, if the probability of refinancing are very similar or even are the same, if ZS is equal to ZF, regardless of what happens in the first period, then that reduces, or that even brings to zero, the benefits of predation, because then the probability with which firm 2 will be around in the second period does not depend on predation if ZS is equal to ZF. The opposite case, in which ZS would be equal to 1 and ZF would be equal to 0, meaning that the firm is refinanced if and only if it succeeded, that increases a lot the benefits of predation for firm 1. So let's bear in mind that we need a pretty small difference between these probabilities of refinancing in order to deter predation. The second consideration is we need the contract to address moral hazard, right? We need the contract to make sure that the manager is going to exert effort in the second period and in the first period. So what the manager gets is going to depend, of course, on the outcome in the first and the second period. And so we're going to use defer compensation. We only need to pay the manager once, and we're going to do so in order to provide incentives for effort in both periods. So we know that if the manager is going to exert effort in the second period, PH is equal to 1, so the firm is going to succeed for sure. It's going to get profits D. But we're also going to want to make compensation conditional not only on the outcome in the second period, but also on the outcome in the first period. And so the manager is going to get different amounts depending on whether the first period was a success or a failure. And why do we want to do that? Because, of course, whether or not there is success or failure in the first period depends not only on predation by the other firm, but it also depends on moral hazard within firm 2. And in particular, we want to ensure that the manager of firm 2 has incentives to exert effort, not only in the second period, but also in the first period. Okay, so let's start with the incentive constraint for the manager of firm 2, the firm potentially subject to predation in the second period. And so there's two cases, right? There's the case where there was a success in the first period, and then a case in which there was a failure in the first period. And in both cases, we want the manager of firm 2 to have incentives to exert high effort. Of course, you may argue this case will not be observed, right? Because we will be in a situation in which there won't be any predation. And so in equilibrium, both firms are going to succeed in the first period due to this assumption. So this is correct. But to make sure that this equation is satisfied, we also need to ensure that the manager is going to exert effort in the second period following a failure in the first period. Now this is, otherwise, this expression would not be equal to this. So these are the out of equilibrium conditions, which are important to bear in mind. Okay, so let's start with the case in which there was a success in the first period. So in this case, if the manager exerts high effort, and so here, of course, pH is equal to 1, yield will get this, and if the with this probability, which would be equal to 0, yield will get 0 because the firm is going to produce 0. Now, if the manager exerts low effort, he is going to get the same amount, but with this lower probability PL, but it's also going to get some private benefits B0. Okay, and so if we rewrite the contract, this is equal to this. Now we still need to take into account the difference between pH and PL. This is delta P. Now, if you look at the second equation, this is what happens if there was a failure in the first period, in which case the manager is going to get this in the second period following a success, which is again pH is equal to 1. And he gets the same amount of probability PL if he exerts low effort in the second period, in which case he gets some private benefits. Okay. And so here we need this equation to be satisfied in the second period. Okay, so we need these two equations to be satisfied. So here you may think easiest way to do that is simply to set RBS equal to BF equal to this amount, right? So you minimize the cost of compensation for the manager. Would this work? Well, let's see. Now let's consider the incentive compatibility condition in the first period. Okay, so now the manager is going to take into consideration what's going to happen not only in the first period, but also in the second period. So on the left-hand side, this is the expected payoff of the manager if he exerts high effort in the first period. The expected payoff to the manager if he exerts low effort in the first period. So if he exerts high effort with probability PH, which is equal to 1, the firm is going to succeed, in which case it will be refinanced with this probability, and the manager is going to get this amount. With probability 1 minus PH, in which case it would be equal to 0, the firm would fail, and it would get refinanced with this probability, in which case the manager would get this amount at the end of the second period. Of course, if the firm is not refinanced, the manager does not get anything. Now, if the manager exerts low effort, now the firm will succeed in the first period with this probability, in which case it would get refinanced with this probability, and the manager would get this much. If the manager exerts low effort again, the firm is going to fail with this probability in the first period, in which case it will be refinanced with this probability to still operate in the second period, and the manager would get this amount if it is refinanced, and the manager also gets private benefits P0 from exerting low effort. Okay, so rearranging this expression, we get the following equation for the incentive compatibility condition in the first period. And so here, as you can see, so we have the same term as we had there, but on the left-hand side, we have this. And so already you can see that if we set these two amounts at the same level, so if we equated both this term and that one to this, and if we set ZS equal to ZF to deter predation, you can see that this would be equal to 0. And so the first period incentive constraint would never be satisfied. And so this gets back to the issue we mentioned here, right? If you are going to refinance the firm no matter what happened, then that can create a moral hazard problem in the first period. Okay, so how can this be avoided? Well, there's really two things you can do. The first one is that you could reward the manager more in the second period following success in the first period compared to following failure in the first period. The other thing you could do, and this is possible as long as duopoly profits are strictly positive, is that you may want to have ZS larger than ZF. Okay, so in this case, the probability of refinancing of the firm would be larger following a first period success than following a first period failure. This is not great in terms of avoiding predation, but predation would still be avoided as long as this is satisfied, right? And furthermore, having ZS larger than ZF would be very effective in addressing moral hazard in the first period. It will make sure that this equation is satisfied. So already you can see the trade-offs in this model. Okay, now let's look at the perspective of investors. And so we're still going to assume that this equation holds, so that the refinancing contract parameters are such that this equation holds. And so there's no predation in the first period. So what is investors' break-even constraint? So in equilibrium, there will not be any predation. So they are going to invest this much in the firm in the first period. And this is the initial wealth of the firm at the beginning of the first period. This is the investment cost required. And so this is what investors are going to invest in the firm at the beginning of period 1. This is what they will get. In equilibrium, there's no predation. So each firm gets duopoly profits D in period 1. Now the firm is going to be refinanced with this probability because indeed In equilibrium, there's no predation, so the firm is always going to succeed in the first period. This is what you must give to the manager following success in the first period. This is what the firm is going to produce in a second period. Again, because pH is equal to 1, so the firm will succeed. And this is the amount that it needs to invest in the second period. So we need this to be greater than 0. But here the problem you see is that this is negative, meaning that this term will be negative because RBS will be at least equal to that, right? So this term is negative. And so it's not clear that with ZS equal to 1, investors will necessarily break even. And so there's going to be 2 cases. But already you can see that to deter predation, so both ZF and ZF, the probability of refinancing following success and failure, are going to matter. Even though in equilibrium, only the level of ZS is going to matter because predation will be deterred, and so the firm will always succeed in the first period. But to ensure that this is indeed the equilibrium, ZF cannot be too low, because if ZF were too low, this condition will not be satisfied. So you must refinance the firm with a positive probability, even if the firm fails in the first period. So this is what's going to be very effective at deterring predation. And so for example, if you set ZF equal to ZS, then there's never going to be any predation because this equation will always be satisfied, even if D were equal to 0. The second consideration is that investment efficiency in this model only depends on ZS, because in equilibrium there will not be any predation, so we only really care about what happens following success, right? But again, this is conditional on deterring predation in the first place. Also, investment efficiency, because investments are positive NPV, it is maximized for ZS equal to 1, meaning you always refinance the firm. So that's what you would like to do. You would like to always refinance the firm in equilibrium. But is this always possible? So it depends. So if we set ZS equal to 1 in this equation, and if this equation is satisfied with ZS equal to 1, i.e. if this equation holds, then you are able to set ZS equal to 1 and to maximize investment efficiency. But if when you set ZS equal to 1 in this equation, then it does not hold, i.e. this is the case, then you cannot set ZS equal to 1. So ZS must be less than 1 for investors to break even. And so here the idea is that it is actually costly for investors to refinance the firm in the second period, even though NPV is positive, meaning this is positive, because of moral hazard. Okay, because you need to provide also incentives to the manager, and so you cannot return all the money to investors who are providing the funding. And so because of that, investors lose money when they refinance the firm in the second period. So why would they still be willing to refinance the firm in the second period? Because they are potentially making profits when they finance the firm in the first period. And if these profits are sufficiently large, they will be willing to refinance the firm in the second period with probability 1. But if these profits are pretty small and the losses they make in the second period are sufficiently important, then they will only be willing to refinance the firm with a probability less than 1. So in practice, a contract will not specify a probability of refinancing, which is less than 1, but it's going to include some covenants which are going to be such that a firm will not always be able to get financing in the future. Okay, so a few things to bear in mind here. So in this model, there's several constraints. So the first one is the no predation constraint. So that's going to depend on the probabilities of refinancing. But we also need to take into consideration moral hazard, especially moral hazard in the first period. And to deter moral hazard, as you can see, it helps to have a greater difference between ZS and ZF. And this is directly contradictory to the objective of deterring predation, which is better achieved with a small difference between ZS and ZF. Okay, so you must balance these two objectives and also make sure that lenders are going to break even. And for lenders to break even, if the firm has a strong balance sheet, so meaning if A is sufficiently large in the first place, the firm is sufficiently wealthy, then it's going to be easier to implement the first best efficient continuation policy, meaning you always refinance the firm. But if the firm has a weak balance sheet, so if A is sufficiently low, then you will not always be able to refinance the firm. Even if the bank can enter into a long-term funding contract with the firm. But the most important idea in this model is the effect of a contract between firm 2 and its bank on the behavior of firm 1. If you enter into a long-term contract with your bank, firm 1 may not engage in predation in the first place because predation will be ineffective in the sense that it would not affect the probability of survival of firm 2 to a sufficiently large extent. And this is the case if ZS is sufficiently close to ZF, then predation will be deterred.